Hello, I'm Robin Gibson, and this is the Harvard House Money Morsel. Welcome back. Thank you for joining us again. Don't forget to like and subscribe and click the bell so you get a notification of when we're releasing a new video. I'm sitting today with Michael Porter. Welcome, Michael.
Morning, Robert.
So, Michael, this last week we had all the monetary policy committees around the world meeting, and well, the two ones that really interest us. Let's start with the Fed, shall we?
Yeah, we actually had the ECB meeting as well. So the Fed met on Wednesday night. Robin, I think it was so well telegraphed. Obviously, we all know the political changes, and Trump has been in the hot seat for a little over sort of 10 days now, and executive orders are flying. But despite his protestations that interest rates must fall, Jerome Powell was having none of it.
Yes.
So the US kept interest rates stable. They saw no reason to cut, and they basically indicated that the US is going to be on hold for the next couple of months, probably till May time. May, June is when the market's sort of looking at the first cut now from the US. I think they just want to settle things down and see how Trump's policies also affect the economy, but guiding to definitely a pause, not necessarily a change in direction, but a pause in the downward cycle. We'll see how it goes from there. So ultimately, also what that's saying is that the Fed's quite happy with where the economy is. The labour market's still quite firm. Yes. Inflation is contained, but it's not low. And so, I think they're just taking a chance to have a breather. And the market, it was pretty well known, and the market took it in the stride. It wasn't a surprise.
Yeah. So they pretty much highlighted those two aspects. The labour market, they said it looks strong, but inflation is not cooling quite to what. I mean, those are two key numbers for them, aren't they?
Yeah, it is, Robin. I mean, the labour market still looks very strong, and we'll have US unemployment data out this time next week. But inflation is sort of around about the 3% level. Oil prices have sort of ticked up a little bit. I mean, there's quite a lot just going on day to day, and I think having had this deflationary sort of period, everybody's just being a little bit more cautious and saying, well, hold on, where do we go to from here? Because that initial correction of high inflation is kind of over. Now you need to do the hard work to grind it down a little bit further. Yeah.
So that was Wednesday night, and then Thursday, our crowd met, didn't they? Yeah.
Our crowd met, and the ECB cut rates. Yeah. Our Reserve Bank cut rates by 25 basis points. Mm-hmm. I think the surprise that came out of ours, Robin, was that there's 5 members of the MPC, the committee that meets. 2 of them voted for no cut.
Yeah.
Now, sure, that's pretty surprising, given that the cut was basically guaranteed. And then for 2 members not to actually vote for a hold, actually it was a pretty close decision not to cut. So this in our Reserve Bank also highlighted a little bit of the uncertainty around global politics, tariffs. Maybe one of the implications of Trump in the last sort of 6 weeks has been a much stronger dollar, the weaker rand on the back of that, and it's got nothing to do with us. It's just kind of where the dollar's trading. So I think the Reserve Bank I can understand why they're a bit cautious, but I think we've, on the one hand, you want a cautious central bank, but on the other hand, you can get too cautious. And I think the Reserve Bank is almost erring on the side of being too cautious, and they're going to miss the window of opportunity to cut. And then that opportunity is going to pass, and we're not going to have cut enough.
Yes.
But the Reserve Bank was basically sort of seeing that the repo rate is at sort of 7.3% by the end of the year. It's 7.5% now. So, I mean, we only ever thought there was one more. There were going to be 2 cuts this year. So the next one is, I would say, from yesterday's meeting, it's not guaranteed, Robert, and we'll just have to see what happens with inflation and growth. Maybe on the positive side, the Reserve Bank revised up their growth forecast for this year to 1.8%. And into 2% for 2026. And I think that's very much in line with a lot of the economists that we are seeing. It's sort of between 1.6 and around about 1.8% for this year.
Yeah.
Now, we all know that that's short of the magic 2% number, but we haven't had more than 1% for a very long time. Yes. So it does, if we do get that, that's going to signal some positive momentum. Yeah. So it's positive.
And that aligns with Billy's presentation. Michael, there was There also seems to be a little bit of life in the commodity markets. What's happening there? I see platinum and palladium over 1,000.
Yeah, Robin, gold has been very strong as well, almost at a record high of $2,800 an ounce. Yeah, I mean, I don't know why commodities are moving. Obviously, possibly slightly better GDP growth. I think what maybe what is influencing commodities a little bit is some of the extra sanctions on Russia that Trump put on, that Biden put on right at the end of his term, but also that there seems to be a bit of life coming out of China. We've had the luxury goods companies reporting better results. There's quite a few companies that have got links to China or big exposures to China that are suddenly reporting maybe better than expected results. And it's not to say that China's flying, but I think there's certainly a bit of momentum gaining in China, which would be good news for everybody. So I think commodities are sort of reacting to that a little bit, and then offset by the fear of tariffs. February the 1st is meant to be the day that Trump comes out with this tariff thing, so we'll see if anything happens on the weekend. But again, I think markets are just jostling around and uncertain, and given everything that's going on.
So volatility will remain. Michael, thank you for giving us those insights. Thank you for joining us. Don't forget to like and subscribe, and we'll catch you next time. Goodbye.